least the Western world, went into something closer to lockdown over the course of the fourth quarter, and now as we get into this year, obviously is quite locked. The in the Eastern world, I spent I spent all of the fall in Asia, where the restrictions are quite heavy. The difference between ordinary course of life and life today is noticeable, but businesses are wide open. People are traveling, at least within their countries. And I think there's probably a little bit more investment-oriented mindset, and consumers have come back. So, given 2/3 or so of our profits are coming from Asia, or things related to Asia, maybe a little bit more, we feel pretty good about our ability to recover as the global economy recovers. But we also know that even Asia, for its relative success in fighting this virus, is fighting all the time. So the restrictions in Korea and Hong Kong, Singapore, China, Taiwan, et cetera, are still very, very present. And in fact, the threats are increasing with new variants making their way into the East as well. So I'd say we're cautious about 2021. We saw some good signs of recovery towards the end of last year, as many of our markets kicked back into speed. I think we would expect that some of those cross-border investment type areas would remain slow. But people managing their own money, so our wealth management business, or people financing and delivering on their trade is increasing steadily. People are finding ways to work through this pandemic. So overall, I'd say I'm pretty optimistic about the markets where we operate, of course, about our own performance, but the pressures are still there.
Is it too early to tell whether the vaccination programs are having any real impact on business lines?
Yeah, I think it's too early, and I think there's lots of confidence that's building that this will be successful, and that we will be back to something closer to normal over the course of this year. But in terms of increases in mobility, increases in the engagement of hospitality, it's too early, I'm afraid.
Impairments have been surprisingly low, actually, when you look across the banks that have already reported here, and I don't see any reason why you should be any different at this point. I mean, do you put that down largely to the way governments have intervened to support economies at this stage?
The government support has been a tremendous help. So certainly in markets where I'm sitting now in the UK, but elsewhere in sort of Hong Kong, Singapore, support for businesses through the most difficult time of the pandemic has been critical. Obviously, the monetary support and liquidity injections have been extremely helpful, and very low interest rates are helpful as well. So I think that, combined with the actions that banks themselves have taken, obviously including Standard Chartered, to work with our customers very, very deliberately to help them through difficult times, through self-introduced payment holidays or debt moratoria, things of that nature. So, but that also clouds the impairment picture, because for sure there are some companies that will have a tough time recovering from this pandemic when we're all vaccinated and the world is feeling more like normal. Some people had business models that were challenged before the pandemic, that will be more so afterwards. Other people have just been stretched a little bit too hard. So I think it's too early to to sound the all clear in terms of the impairment issue that we and other banks have faced. But you're absolutely right that the signs so far have been encouraging, and I think it's a combination of good credit standards going into the crisis, good government activity throughout, and then working very closely with our clients to help those who really are in trouble to find a way to salvage their business model.